Okay, we'll go ahead and call the Firefighter Pension Board meeting to order for Tuesday, September 22nd. First item on our agenda is the Citizens Open Forum.
Hi, everybody.
Hello.
My name is Pam Settle. I'm currently chairing the Ordinance Review Committee. So I know it's odd when there's somebody actually sitting in the room. Who is that? So my name is Pamela Settle, and my real reason for coming here today is that as of today, I am officially qualified as a candidate for Oldsmar City Council for seat 1. So I wanted to introduce myself to you just briefly. While people in Oldsmar may not be familiar with my name, I have been supporting families in Pinellas County for about 16 years. First with United Way, and then as Director of Marketing for Pinellas County Government. And when I was there, I created the Know Your Zone campaign and wrote the Pinellas County Hurricane Guide, which won the Governor's Award that year. So I am very much versed and educated in emergency management and also in informing and educating our citizens. Excuse me. Allergies have been really rough the last few days. But most recently, I have been the publisher of Good Living Magazine. And so for the last 10 years, I've been producing a magazine to educate families in Pinellas County. And I've done that through the schools and the preschools. And my partners have been Pinellas County Sheriff, Pinellas County Schools, Juvenile Welfare Board. So I am very well aware of what's happening in Pinellas County when it comes to families. I'm also a small business owner, so I also know about small businesses. And what I'm looking to do is bring all of my experience and knowledge and energy and background and dump it right on top of Oldsmar. So I'm really excited to come and be on board as in a leadership position to help grow the city. Safety is a major concern. Oldsmar is home to families and it's home to businesses, and safety is first and foremost on their minds. And so when it comes to the fire department, our first responders, very much in support of the work that you do, and I will be a candidate and hopefully a council person who will be in support of the fire department. My husband is an educator, so I am the wife of a public servant, and I know what that means when it comes to salaries and benefits and health benefits and what that means to the families at home. And so I just wanted to just come briefly and let you know a little bit about who I am. The campaign will kind of get into full gear probably after the November election. You'll be seeing more of me. I hope I have an opportunity to share more about myself and learn about what the issues are for the fire department here in Oldsmar and how I could hopefully be of service to you. Thank you.
Thank you. Thank you. Anyone else for open forum? Okay. So the first item on the agenda is approval from the minutes from the June meeting.
I move to approve the minutes from the June 23rd, 2020 meeting.
I second.
Any discussion, questions? All in favor? Aye.
Aye.
Any opposed? Second item is presentation of the quarterly plan investment report.
Okay. Oh, perfect. Already up there on the screen. So the information in this report will be for the quarter ending June 30th. Of course, we'll talk a little bit about, when we get to the investment parts, July, August, and kind of where we sit today. And then depending on how long the meeting goes, how much the market will or won't have changed, as it seems to be doing a lot of that lately. But again, as you can see, the beginning balance for the quarter, $6.284 million. We saw just under 65,000 in contributions come in. Saw a much needed earnings increase of 836,000. Paid out just over 14,000 in distributions. Had 19,500 in expenses. Your ending balance, $7,152,928.61. And then the next couple pages are just the account statement for the quarter. Any questions about the dollar amounts before we go into the investments? Usually those pages don't bring a lot of questions. So scrolling down to page 19, I believe. Yep, perfect. Okay. So again, for the quarter, you can see kind of top middle there. The fund was up 13.3%. So we saw a much needed, very surprising as far as the speed, the bounce back from obviously what February and March gave us with COVID and shutting down the economy and of course all the market turmoil that came with that. So again, market bounced back incredibly fast, which is great news. It's still, I think, even we sit and talk and we talk with the experts and everybody's still kind of amazed at the whipsaw. But again, that's good news as far as your fund goes. So that for the fiscal year to date, that put us just into the positives at 0.8%. Which again, while that's not a big number, considering we were down, I think the prior quarter we were down a little over 16% just in that quarter. The fact that we're in the positives at all was kind of amazing and again, very good. July was extremely strong in the market. Conservatively, you probably added another 3-4% just in July. To the total fund. And then August was one of the best August the market's seen in about 30 years. Conservatively, we probably add another 2 to 3% in August. So at the end of August, we were sitting in the vicinity of your assumed rate of return. Obviously, we're coming up, 8 days from the fiscal year end. So that's kind of everybody's, how do we look as it relates to the assumed rate and what kind of impacts we might have from there. So at the end of August, we were in the vicinity of that, maybe even a little over, but conservatively, we were at least kind of right around there. The first few days of September, that rally continued and things were really looking great in the market. And then all of a sudden the volatility hit. And the last couple weeks, we have seen tremendous volatility, not only just from day to day, but we've actually seen some days we've seen a lot of intraday volatility where the market's been up several hundred, down several hundred, closes up 100, or vice versa. Today I know the market, I think, opened up a little bit, was down over 100. Last I checked before we started the meeting, it was back in the positives. So we're seeing a lot of wild swings. Some of that is attributed to there was a lot of, so in this run up, especially the last few weeks, it was a huge run up in the tech stocks. I don't know if people were following the Teslas of the world, which, that's one of those, boy, don't you wish you had a crystal ball there. Tesla which funny enough, you don't actually have much exposure to it in here, but it kind of just gives you a big picture of the market and why the total market's reacted the way it has. Tesla less than a year ago was trading for $225, $230 a share, roughly. As of a few weeks ago, it got around $2,300 a share. So less, maybe a 10-month time span. Caused it to split 5 for 1. Then the very next day, I think it was up roughly another 40, which is the equivalent of almost 250 more points the next day. Apple had nothing to that level, but had a huge run up, caused a split. It split 4 for 1, bounced. And usually after a split, you'll get a big bounce maybe in the next day or so after that, which it did. Then everybody started taking, okay, these are overvalued. We've made a lot of money. Let's start selling off. So we saw a pretty good sized correction in the tech sector over the last couple of weeks. So that's kind of driven a lot of the ups and downs of the market, more of the downs. But then again, we've seen some of those stocks actually pop back up as well. So there's a lot going on there. Then there's just a lot of, the market kind of stabilizing because we have, as quickly as it went down in February and March. I mean, essentially I think it was a 16-day event. In other words, the market crashed in 16 days. It bottomed out, which is it's unheard of. I saw a stat the other day, and I apologize, I can't recall, but it was the only other market event ever that was even in the vicinity of that was in 1929, the big crash from then. And I don't even think it was maybe 30 days that it took to bottom out. 08, 09, as bad as it was, I think took right about 8 months to go to reach its bottom. So it took longer. So 16 days was very unprecedented. Well, the bounce back that we saw over the last quarter was darn near just as unprecedented. And so now the market's, I think, is looking kind of stabilized, figure out what's going on after all of that. Additionally, really only in the last couple of weeks have we started talking about a presidential election with everything this country's experienced this year and globally everything that's been experienced. That was kind of an afterthought until really just the last couple of weeks, which by itself in a normal year, which 2020 clearly is anything but normal, that would create a lot of market volatility. So we have a lot of things going on right now that's got the market doing a lot of wild swings. All of that to say, even though things are so September last couple of weeks overall, it's been volatile. There's been a few good days, more bad days, so we've pulled back some. All that to say, we're still, given what happened in February and March, we're way better than we would have ever expected. But because there's 8 days left in the quarter, in the fiscal year, I'm not willing to sit here and say, oh yeah, we're going to finish at 7% and it's going to be a great year. I just, there's no telling what just even this next week's going to bring. There's just too many wild, crazy things happening right now. It used to just be, well, what were the numbers that these companies put out? And that's where traders made most of their decisions. Now it's just, as we've talked about, really, I mean, all last year, the market seemed to be running on what was the latest tweet as it relates to the U.S.-China trade wars. It's just information comes at us so fast, and the market can get impacted by information that may or may not even actually impact the numbers, but it impacts traders and the mentality and the emotions. And so I don't know if we fundamentally changed forever, but it certainly, in the foreseeable future, it just seems like information is guiding the market in a way that we haven't seen before. And I doubt that genie's probably ever going to go back in the bottle. But if we just look a little more, so that's kind of the big picture. Real briefly, your fixed income, it's been a good year overall. You can see your broad market or your high quality fund up a little over 1% for the quarter, up almost 7% for the year. That was the only positive addition in the prior quarter, and that's again, when the equities take the big hit, the market's pulling back. People either get out of the market or it's a flight to quality. And in this particular case, it was a flight to U.S. Treasuries, and that's about it. I mean, people were just scared of anything that had any sort of risk profile attached to it. So the Core Plus actually had a really rough quarter, even though it's fixed income. It was one of probably the biggest negative quarter you might ever see. But it's all good bounce back up 5.6%. The reason is, again, that's got global exposures, corporate debt. It's more than just government-backed securities. The good news, so a little bit of the headwind of why your fixed income is it's lagged a little bit this year, although really the high quality fund has actually outperformed ever so slightly. But you have less exposure to U.S. Treasuries than the benchmarks. It's hurt you a little bit this year, but going forward, that should actually be a positive. And the reason being is the Fed came out a few weeks ago, said interest rates are not only are they going to keep them at zero, but they said something they haven't ever really done before, which is we plan to do this for the next several years. They don't typically talk 3 years out or multi-years out. They're talking, next quarter, maybe a couple quarters. So that was a kind of an unprecedented type of statement from them. So if rates are to, again, stay where they're at now, and of course this is a big if, we don't have any other COVID scenarios, any other things that impact the equity market quite to that level, then in theory, fixed income or U.S. Treasury should not provide any sort of return in a normal market scenario in the near term. So being underweight going forward will actually will be a positive, all else being equal. Looking at the equity markets, again, as we already kind of touched on, a huge rebound. Your large cap up 22%, your small mid cap up 22%. Kind of an interesting note on your small mid cap fund. That manager, Atlanta Capital, has historically been the best performer in the portfolio by far. They've done it for we only go back 10 years, but you look back last 20 years, tremendous outperformance. They've actually lagged a bit this year. But again, after having conversations with them, turns out it makes perfect sense why, and it's nothing to be concerned about. What it is they are very underweight biotech. Biotech is a much more volatile sector in general, and this manager just kind of avoids volatility as a general strategy. Biotech has been your biggest winner this year. It didn't pull back as hard in the first quarter, and it had the biggest rally in this past quarter. And as you can imagine, COVID has driven that market, right? The race to the cure, the race to the vaccine, all the other companies related to anything to do with that. So the biotech has seen a big rally there, and you just don't have that level of exposure with that manager. So there's kind of where you're seeing the underperformance. So again, nothing that is concerning or interesting. And again, their historical performance is so good. You have 1 year of underperformance. It's nothing that we get concerned about, but it's just kind of an interesting to note why that took place. Looking at the next page, your international fund, international markets similar to U.S. markets saw a global shutdown, and then the economy started to reopen a lot of places. So you saw the big rally. Additionally, the managers, in addition to taking part in that rally, they had just a great outperforming quarter as well. You can see up over 23.5% versus what the index at 16%. So really good quarter there. And then kind of the other interesting talking point is the core real estate. This was the first negative quarter we've had since we introduced this into the portfolio. Almost all of that can be attributed to the retail. So you have about a 12% exposure within the real estate to retail, your brick and mortar centers and things like that. There was about a 9% markdown in the value of those assets last quarter, obviously due to COVID shutting down the economy. People are not going and shopping in these stores. The flip side of it, your industrial, which includes warehousing, saw a nice spike and help offset some of those losses, because while people did not go into the brick and mortar stores for whether they were closed or people just weren't leaving or all the above, what were they doing? They were sitting home, buy now, click. So Amazons of the world, Walmarts of the world, their growth, they've had a really strong year. And then the warehouse, e-commerce needs that warehousing space for all of the deliveries and everything that goes with that. So that's seen a really nice bump. I don't know if y'all saw Walmart a few weeks ago announced that they're starting a program just like Amazon. You join their membership program, and they're going to do free deliveries. So the world is it's a changing place. I mean, I think we all kind of saw that e-commerce was where things were headed anyway. This year's probably just kind of accelerated that pace. Not the brick and mortar will go away completely, but clearly we're seeing a shift in how people do their shopping. And then by forced to stay home for months on end, that's just kind of sped a lot of that process up. Another interesting thing to note, which is nothing's happening now, but it's something that we've talked with the manager and they're following extremely closely, is office space. You have about probably a 25% or so exposure to office space with this. That's been a hot topic, is what all these large companies, what are they going to do when you get the all clear to everybody can go back to work as normal, assuming that day's coming. Are these large companies that have thousands or tens of thousands of square footage, are they going to say, well, we kind of like having our employees at home and we can lessen our footprint and kind of make a shift? And so there's a lot of conversation around that, and will that happen or won't it? I know our managers clearly are going to be watching that closely. Now, the good news there is if there is a shift, most of these are long-term leases, 5-10 year plus. So it's not like everything's just going to all shut down overnight. So they'll kind of have some idea if that trend takes place. I think the thought is that that's probably ultimately not going to happen. There might be some individual companies might make some shifts, but overall, I think that the concept of having people together, collaborating, working together, what I'm hearing is people are thinking that's probably still going to win out. Maybe you let people work from home 1 or 2 days a week, or maybe you don't have quite as dense as an office. Maybe you realize, 20 of those people or 100 of those people, they can work from home, but we still need the majority of our people. So maybe all this everybody in, we can kind of have a less dense space, but we'll still need the space. But that's something that we'll be keeping an eye on over the next. Really, that could take several years or so to shake out and see how that plays out. So
yes, I can hear you.
So overall, as we sit today,
you need me to speak up or anything?
A pretty good place for the fiscal year. We're in the vicinity. of your assumed rate, but again, that's today. So any questions or things you want to talk about anymore? I know I think we're going to talk about some asset allocation potential changes, but as it relates to this strategy going forward with the managers, any questions or?
No, doesn't. Thank you.
Okay. Cool.
But yes, the next item is discussing investment allocation options.
Okay.
We talked a little bit about last meeting, but we decided to wait until we had more members here.
Okay. So I assume you would like to continue that conversation. So I dropped a couple handouts. Hopefully everybody's got them in front of you up there. These are just showing you what the 70% allocation is. So right now you have 60% in equities, 30% fixed income, 10% real estate. The discussion, I think, was to up equities. So you'd be at 70% equities, and then you take 10% out of the fixed income. So 70% equities, 20% fixed income, and you'd still have 10% real estate. So the real estate part wouldn't change. So it'd just be a shift of 10% out of fixed income into the equity side. And then what you have there is kind of the 70%. And we've actually, you've got about as good a case study as you could have. You had one of the worst quarters you could ever have in March. So I brought you March. And then we had one of the best quarters you could ever have in June. So you can it lets you kind of see some of the discrepancies. So if we look at, so your 60% fund, we're 13.3%, but then looking out over the longer time periods, which is, I think when you're talking about this, you don't want to, any one quarter really shouldn't matter a whole lot. You're looking at, you've got your 3-year at 5.4 or 5.6%, 5-year 5.85, 10-year at 8.11. But for the 70%, again, as of June, if you look, the 3-year 6.13, so half a point, 0.53% better. 5-year 6.39, so again, almost right on 0.5% better. 10-year 9.08, so a little bit better performance at the 10-year mark of what? Almost a full percent, not quite. Better over the 10-year. So when the consultants are building these options, when they're looking at everything, they model everything out. The way, just to give you a quick backstory on the process that is used and the thinking that goes into it is, they don't say, okay, how do we think we can get to that 7%? What they do is they model out, okay, if we have this allocation over the long run, what is the most likely scenario? Not can we, what is the most likely average return over an extended period of time? So in the allocation you're in now, the 60%, the modeled out numbers, so the expected most likely result is a 7% rate of return. If you move to the 70%, that model would be, we would expect 7.5% to be the most likely average return over the long run. So about 0.5% difference. And in the 3 and 5 year numbers, those have played out pretty well. They're almost spot on. The 10-year number, you do get a little bit bigger gap there. Probably some of that, actually, let's look at the 10-year number in March. And you don't have the 60% handout, but the 10-year number at the end of March in your portfolio, where you are now, 6.14. And then the 10-year number in the 70 at the end of March was 6.76. So it was kind of a little closer to what we would expect at the end of the March quarter. I guess just the rally being so great in equities this last quarter kind of pushed out the gap a little bit. But in general, the 0.5% difference is what you would expect to be the difference in the portfolio. So the trade-off is you get more, which is why these were really good to have these 2 quarters for you all to look at, is the volatility that you get within a quarter or within a year. If you go to 70% equity over time, you expect 0.5% more of return on average, but you'll get more volatility. In other words, so let's look at the back, because the good quarter, we don't mind more return in a better quarter. So let's look at a bad quarter. So we go back to March. Your portfolio in March was down 15.3%. The 70% was down 17.74%. So you do get a bigger gap in one quarter. Now, again, that's kind of, you're looking at arguably possibly your worst case scenario. So you get about a 2% gap there for one quarter. But if you look at a 1 year number, so in March, so including that March quarter, your 1 year number for your fund, so 60% is 6.74, actually negative 6.74. The 70% was negative 8.41. So a little closer gap, but still a little bigger gap. But again, you're seeing in a wilder swings in smaller swinging normal quarters where you're up or down 2%, 3%, flat. You'll see closer to that 0.5% gap. So really then what it kind of comes down to is, okay, what does the volatility matter? Well, the volatility matters in the contribution rate, right? So when you're having your actuarial valuation each year, the market return is one of the biggest parts that drives contribution rate. So if you get bigger swings in the market, then the contribution rate is open to having a little more fluctuation and volatility within it. Now, shouldn't be all that bad when you play it out, because again, I think, and I apologize, I don't know off the top of my head, if a smoothing technique is used with your alts plan. It's not?
No.
Okay, because if you use a smoothing technique, that actually makes it even easier. Their actuaries sometimes will use a 3 or 5 year where they're taking average returns over the last 3 or 5 years and using that, which smooths that contribution rate out even more. So that's always something you all could look at as well, is introducing that option, because that's up to the board. That's not a right or wrong. Most plans do use it, but it's not a right or wrong either way. It's kind of whatever you all prefer. So that is something you could take a look at too if you wanted from a volatility standpoint. But that's what you're looking at is, do you want to, in theory, do you want a 0.5% more return, which has mostly played out to be that. And in return, you take a little more volatility from 1 year to the next. And that's kind of the discussion points that you would be looking at to whether or not you want to stay where you're at or make a change.
Discussion?
Yeah, so one of the questions I asked in the last meeting was, were any of the other municipalities making any changes going from a 60-40 to a 70-30 that you've experienced or even beginning the conversations?
We have definitely, I've had a few conversations over the last couple years or so.
I mean specifically this year.
Oh, specifically this year? I've not had anybody switch this year. We've had a couple people switch over the last couple years. We've had a handful of conversations over the last couple years. This year, have I had anybody? Nobody has switched this year. I'm just trying to remember if in the last couple quarters, if I've had any boards begin a new, just start a conversation. I may have had one or two. Nothing. It hasn't been a hot topic necessarily. Just to kind of expand on that a little bit, the allocation you're in the 60% equity, that is the majority of our boards, but we do have a decent amount in that 70%. I don't think it's a right or wrong. The only time if it's marrying it up to your assumed rate of return is kind of one of the biggest aspects, and reason being, when we're preparing these annual reports to the state looks at what is your allocation, what is your corresponding assumed rate of return that you're using, and is the state willing to accept that those make sense together, because you want those annual reports obviously approved so that you get your state money. I mean, that's
yeah. No, I mean, the only reason I was focusing on what other folks were doing is I just wanted to better understand, with the way the Fed has come out and with the movement and locking in rates basically at nothing, how that was going to cause a headwinds to the overall portfolio over the next 3 years.
Right.
And that was where my bearing was going on it.
And you're exactly right in your thinking. I think I've had more conversations about lowering assumed rates than upping equities. Not to say I've had a lot of them, but I probably have had a couple more related to that than related to upping the equity allocation. But we have, I mean, the vast majority of our boards are sitting right at 7%. We even have a few that are at 7 and in the 70% equity allocation. But that's why I say most are in the 60 and most are around 7% because those kind of match up. You know, the states, there's some talk, the states, the FRS is 7.3. They've been slowly, they're slowly lowering. They've been lowering 10 basis points a year. So they were 7.5, 7.4. I think they're at 7.3 right now. Don't quote me, but they're somewhere right around there. But they're doing 0.1% essentially a year right now. You know, I've heard some people say, oh, you got to get down to 6.5 or so. I mean, that sounds great. The problem you have to look into, and I'm not opposed to any plan that says, well, let's go to 6.5%. That's going to have a huge impact on the contribution rate, a huge impact. And so a lot of times it just comes down to it's the cost of that change is too great to make that decision. We don't have any plans under 7. At 7, you're still on any plan that's at 7 is on the low end of the state in general. So I don't think you would ever be having any the only place you're going to raise eyebrows right now at all, and it's not like, oh my gosh, because there's way worse out there, is if you're at 7.5% assumed rate of return, you're only 60% in equities. It's conceivable that the state might come along the next couple of years and say, hey, maybe we need to look at this, you know, that something like that. But it's not that would be the only scenario where I think you might be pushed to have a conversation. And we would recommend that too, to plans that we do have one plan that actually is at 60% equity allocation. They have a 7.5% assumed, and we are actively trying to find a way to work them down to 7, or they need to change their equity. And actually we're meeting tomorrow night, and that's probably going to be one of the topics again.
Any other questions or discussion?
So we're targeting 7 right now, correct?
Yes.
That's what the last valuation report was done at.
All right. Yeah, I mean, again, and I'm just playing the fiduciary piece of throwing it out here so that we have the conversation about it. Again, my concern is, and I'm not saying we should change it at all. I'm just saying that it needs to be a discussion, and that you're looking at a sailboat now that has lots of barnacles on it. And with them locking in rates, basically for at least 2 years, if not 3, and if you haven't refinanced, do it now, that you're literally slowing that boat down. And that was my concern, that 40% would become a big drag. And that's the reason for my questioning.
So it's more to lower the 40% than the equities, the fixed income.
Yeah, it was to lower that fixed income piece of it, because that's becoming the barnacles.
And you're just quickly, you're at 30% in your fixed income. So you would lower it to
10% real estate, but that 10% real estate, unless you're going to tell me they're all cell towers, there's still some serious questions out there.
Oh, no. Well, yes, there is definitely, sure, there are questions about how real estate may perform in the short term. I will tell you, this particular portfolio, the way it's constructed, the reason we went with this particular manager and the way they build it is that they don't have the interest rate sensitivity that other real estate portfolios might. So yes, there could be real estate questions, but not due to interest rates, due to other factors.
But as far as the real estate component, it's debt service and those people being able to pay the bills.
Exactly. Yeah.
So yeah, we haven't had a recommendation to change it. My personal opinion, and always open for more discussion, but our plan's pretty sound right now, and I don't know that I would want to take on more volatility in that aspect at this point. But I think, yeah, like you said, it's a discussion that needs to be had, and we should look at it again, depending on how things are performing.
Yeah, and again, I'm not saying I want to change it, but I mean, as far as if everybody starts jumping ship and getting out of the 40%,
Won't
would
be
you
the
let us
last one
know?
standing.
Right.
Yeah.
Yeah. And no, we definitely, 100%, we're not seeing anything like that happening. Not to say it might not in a couple quarters, but currently that's not, especially again, because you're at the 7% assumed rate. So, we look at it's quite hard to do often, but we try to keep our eye on the long-term numbers, not the next 2 or 3 years, but the long-term numbers, I think 7% and your current allocation still match up. And if they don't, that's one thing internally that we do. We just had a meeting with our board actually last Friday where our investment advisory committee sits down with the consultants, sit down with managers. We do this on a quarterly basis ourselves. And we look at, are there strategic changes that we need to make sure that this portfolio gets that 7% or that 7.5% or whatever it is. So we're constantly monitoring that on our end, which allows you all to, you don't at least have to monitor it quite to the level because we're doing a lot of that heavy lifting behind the scenes. Right. So we are keeping an eye on that. So if there are changes where we think, okay, long-term, this is not going to happen, then that's where we'll either come back to you to say, hey, we think you should look at this option, or we'll make actual strategic changes to the portfolio as well. And then obviously we'll be keeping you all.
Can I ask one more? I'm sorry.
Absolutely.
Have you guys factored into this portfolio at all for the fixed income specific, the 30%? The very unlikelihood that they go negative on rates? I will be honest, I haven't asked that specific question. That topic has only come about in passing, which leads me to believe, but I can double check, leads me to believe they're not positioning themselves with that expectation in mind. I think they're positioned with that, thinking that won't happen, but I can certainly confirm and get back to you. But just based upon conversations, I don't think they're positioning to that. So I certainly ugly thought.
I hope, just in general, I hope that doesn't happen. I can't even wrap my head around how that works. I've had it explained to me 10 times and I still don't think it makes any sense, but.
Thank you. Any other questions, discussions? Thank you.
Before we leave this, I do have a question on the report. Amy, could we go back to, I think it's page 7 or 8? It doesn't involve you, Jeremy. It's just something on the report that I've been wanting to question, and I need to keep going back farther. It's like the 2nd or 3rd page. There's a, keep going. Keep going. Keep going. Oop, right there. On the plan account statement, there at the bottom, there's a name crossed out. And I think I understand the reason. But my question is, being that this report's supposed to be transparent as possible, that all I see is money going out and not where it's going. Maybe it would be best to have a beneficiary in there, but just to have something blacked out.
So there is a name associated with it, and city staff blacks it out because it's exempt from disclosure by the Florida statutes. I mean, in private, Cindy Neno can update you on who it is. That might be the best way to handle this, but there is a reason why it's blacked out.
I know who it is, and like I say, but I think maybe beneficiary should be something in there other than just a black.
Yeah, I think he's just saying as a way to present
Beneficiary
it.
or
Because
generalized
it's not very
term.
transparent, and it sort of bothers me. I'm just bringing it up if that's what they want to do, but I would
Be a question for Pedro?
Well, I think, whoever puts the report together could change what it says on that line, and it just says beneficiary and then says the name, and then we black out the name but leave the word beneficiary. I don't know how much different that is from
Well,
having a blacked out
that
name.
could
It's
be
still not somebody identified.
Here, I just don't, would like to have some type of legal ramification or some type of nomenclature in there, so it's not just a black streak. I mean, it's a public report, right?
Right, I definitely see your point. And Pedro, did you have any comments?
No, I mean, I was just trying to, I'm not looking at what you guys are looking at, but I'm just, is this with the line that has the beneficiary's name?
Yes.
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 It's the distributions.
And so what you would want to see is the actual name, or what is it that you, I guess that's the part I'm not.
Well, what I'm saying is some type of reference other than a black streak, because like I say, we, it's supposed to be transparent, but,
Would you prefer, instead of a black streak, maybe we just write in, name redacted, something like that?
well, I mean, couldn't it be, identified as a beneficiary payment or something like that, other than just a black streak?
Oh, I understand. Oh, you mean for on the actual agenda?
For the redacted
On the
report.
statement that's included in the agenda.
Right, I got you. Okay, I understand. Sure, it could be something. Yeah, that could be something like that to just reflect what the payment is for.
I couldn't understand.
Didn't understand. Can you repeat that, please?
That I was saying that yes, it could certainly be revised to just reflect what the payment is for.
Okay,
So
just,
beneficiary payment, something to that effect would be fine.
I mean, I just think that's in the best interest of the board up here for all of us, and I've been wanting to question that previously, and we've been pretty tight, and I just wanted to bring it up this time.
Thanks to report. This is just the feed, right?
Well, I believe this is redacted by Ann, the clerk?
before we send it out.
Correct.
We put together the report,
Right.
right? And you get the account statement from us, and then you redact the name.
Correct.
Yeah.
I get it full. We redact it before we put it in before we send it out to everybody.
Instead of PDF, we could just put beneficiary next?
Yes.
Thank you.
Okay, we'll change that to plan beneficiary without putting a name in there. I definitely see your point. Make sure it's not, made out to, like you said, somebody else.
It's all going to Kenny.
Thank you.
Thank you. Any other questions before we move on? Okay, number 4 is the presentation of the administrative budget report for the quarter ending June 30th.
Okay, this is, it's not for June 31st, it's for June 30th.
Sorry.
So I apologize for that.
Oh.
This is, it's, the budget itself is a statutory requirement. We present this as a courtesy, so the pension board can see the progress where we are through the fiscal year and just make sure that we have the budget compliance, that we're following along as we're supposed to. Everything looks great through June 30th. You will notice that the last meeting we approved, or the board approved, the dues for the FPPTA. We did make that payment, however, it is reflected in July. So if you look at the July monthly statement, you will see that FPPTA payment for $620, which will be reflected on our 9/30 report at our next agenda. But otherwise, everything is right on target. Looking good, no concerns.
Questions?
Anybody have any questions?
Which takes us to the next one, which is adoption of the administrative budget for next year, fiscal year 2021.
Okay, this is essentially the same budget. However, because the plan has been growing, we added a little bit more flexibility in there for the administrator fees. We added an extra $1,000. I think it's only $1,000 more, but I think it will still fall well within the parameters and, where we need to be as far as the budget. So this is, as I stated before, this is a statutory requirement for the board to adopt this budget. It will be posted on the website, and it will be sent to the Florida League of Cities and then become part of the official plan documents. Do we have any questions?
Just need a nomination to approve.
Make a motion to approve the double budget.
I'll go ahead and second it.
Okay. Any discussion or questions?
I'm sorry, I feel like I'm a pain in the neck. What's the total value of our portfolio right now?
7.15 or something as of June 30th.
The July 31st value was about 7.4 million.
Okay.
Yeah.
You don't have your August statement yet, or you just don't have it here?
I don't have August yet.
Oh, really?
You haven't seen that yet, have you, Amy?
No.
Should be coming out any day.
Yeah,
We'll forward it
okay,
as soon as
yeah.
we receive it.
No, I'm just looking at it on a basis standpoint, how much the fees are costing of the budget. But they're substantially going down with the growth of the thing. So we're in better shape than we were 2 years ago. So
Yes.
that's all.
Yeah. And our fees on a relative basis go, as you grow, the dollar goes up, but the basis.
No, well, I'm looking at the budget as a whole,
Okay.
not you guys.
Gotcha. I think we're the only one that bill you on a percentage. I think everything else is a hard dollar
Yeah.
cost. I think we're the only ones that do it on it.
Yeah, no, I'm just talking about this specific budget in general. Gosh, it had to be a huge amount the first few years. I'm sorry. No more discussion.
All in favor? Aye.
Aye.
Any opposed? Budget's adopted. Next item is presentation of the premium tax payment.
Okay, the premium tax distribution, we did receive the first premium tax distribution in August, or September, yes, August. The amount is 60.
Making weird noises there.
Okay, the amount of the premium tax distribution, number one, that we received is $67,070.92. This is a slightly increase from last year's, but pretty close to the same, pretty much flat. There is a possibility we may receive a supplementary distribution in October. However, we have not received one in the past several years. Part of that is due to the premium tax distribution money itself. The pool has been shrinking slightly, and then also our demographics have changed a bit as we have moved other members into the Florida retirement system. So it's kind of more of a wait and see. They haven't really given us any information yet as far as what we can expect from the supplementary distribution, but as soon as I receive that, I will send it out to you.
There won't be a supplementary this year.
Will not be?
There will not.
Okay.
They actually are over. They spent more than they have this year. So they're actually, I haven't heard how they've officially are dealing with that. I mean, I don't think they're going to send out bills or anything to anybody, but yeah, no, there won't be any supplementaries this year.
Pretty much what we expected.
Any questions?
Any questions?
Thank you. Okay, next is the fee proposal for the actuarial and ordering.
Okay, Madam Chair, we have a proposal for the valuation report. It's that time of the year again where we're at the beginning of coming up on the beginning of the new year. We'll need to order a new valuation report. The cost proposal is for $4,200, which is the same as what we were charged the previous year. I think it is a good value, and so if the board approves, then we can go ahead and order our valuation report.
Okay.
So if you have any questions.
Do we have a choice?
Well, we can go out for quotes For a new actuary,
No, but I mean, having it done.
it's every 2 years, I believe, is the requirement. We've been doing it every year.
Correct. You have, so I could speak for the actuary you work with is as it relates to costs and doing different years. It used to be, and most plans did it every other year because it economically it worked out better. The GASB requirements over the last handful of years have grown. So GASB, there's a GASB report that has to be done annually. That report has gotten so big and costs so much that it has gotten to the point where it's almost the same price to have a valuation done each year, because by doing the GASB report each year, a lot of valuation work is already done. So he does, in the year that he wouldn't do one, he's already done a lot of the work, so he can cheaply add on. And then when the year he would be doing it the every other year, he now has to do less work because he's only doing 1 year instead of 2 years worth of work. So that becomes cheaper. When you average it out over 2 years, most of the plans have moved from 2 to 1 because it ends up being like $1,000 or less. Usually it's just, it's now down a lot of times just a few $100 or so might be the only difference. But you do have, yes, you absolutely have the option. You could do it every other year.
And that's already in the budget that we just approved.
And that determines our contribution rate.
Right.
That's what determines your contribution rate. Yep.
Exactly. And kind of adds stability to the plan, so we know where we stand. We don't have to worry about any wild value, variations in the
Between,
no surprises, anyway. And then we have to do a lot of that work for the financial reporting anyhow, as Jeremy had explained.
So I move to approve.
Any questions or discussion? All in favor?
Aye.
Aye. Any opposed? Okay. Approved as proposed. Second would be selecting an audit engagement option for fiscal year 9/30.
Okay. Madam Chair, this item was tabled from the last meeting, and basically the auditor, Wellshauser and Schatzel, PA, has presented 2 options for the year-end financial reports. The first option is presented as a standalone report, which is one of these. We've historically done these every 2 years, so we did our last one for 9/30/19, which was presented at the last meeting. And then this year would be, if we go with the tradition, we would do the included in the city's financial report. So it would be a couple $1,000s less to have it included in the city's financials. But it's the board's decision whether or not we want to do the standalone report or the included report. So with that, put it to the board for discussion.
And we had put it off again, as last meeting, we had a couple members absent, so till we had more members here. I think Pedro has suggested we do the standalone every year, more to cover the board. Can't hear.
I'm sorry, this is Pedro. I think you asked me a question, but it was tough for me to hear what you said. And I also want to apologize if you heard my son jumping in the mix. He was very eager to tell me something.
We were just discussing doing the standalone report audit or doing the one included in the CAFR.
Oh, right. So, I mean, really, this is I think we've had this discussion in the past, and really, and I think I don't recall correctly, but I know we have it with other clients. Does this auditor, even though it's included as part of the city's CAFR, do they issue a separate opinion to our plan, or is it just they review the pension fund's statements in connection with the city's audit?
If it's included, they review it as part of the city's audit, and they do not issue a standalone report. We'll have a page.
No, right. Okay, so they don't have a separate opinion issued for the retirement fund. So the difference is, again, it's a more in-depth examination. The materiality obviously would change significantly. So the materiality, as defined by the auditor, and we don't know what that is, and I don't believe the city would know either, from the city's audit is going to be substantively higher than the materiality threshold for the pension plan, because obviously we're a lot smaller, right? We have a lot less in assets. So that bar changes. So implicit in that means that there may be some things that are noticed or observed or need to be checked, verified, et cetera, vetted out more thoroughly. If the audit was being done specifically and independent or individually for the pension fund, that wouldn't otherwise come up because, again, quite frankly, it doesn't meet the threshold issue for the city's audit. Now, again, context matters. So the fact that our plan, it is a closed plan, it is, relatively straightforward. There is a lot of oversight already in terms of the annual reporting that we provide to the state each year. We do have a valuation report each year. We have had the audit every year with respect, as included, for the city's purposes, for the CAFR purposes. If you're asking me whether it's important or critical that we have our own audit done, no, I don't believe it is. Again, for the reasons I just mentioned, there is already a lot of oversight in terms of the plan, money coming in, money coming out. There's a lot of different folks who are looking at it and essentially vetting it. There's a lot of different folks that have to authorize money coming in and money coming out. So in terms of checks and balances, I feel comfortable with what the plan has in place. That, coupled with the fact, again, that we are getting an audit and it is being reviewed, at least in part, when the city's audit is performed. I don't think it's necessary. I don't know what the difference in price would be, and I apologize if you mentioned that earlier. It would just really be a cost benefit at that point. So if it's maybe a couple $100, then I would say, yeah, it's worth it to have your own audit, because for that small amount of money, it makes sense. But if it's a couple $1,000, then that may be something where the board decides, I think we're okay right now with what we're doing. And if any issues come up, or if anything comes up where, hey, listen, you guys, there's a discrepancy in this payment, or there's a discrepancy in the way my pension is calculated, or something like that, which may lead to issues that we didn't know about, that the board wasn't aware of, then we could explore that and maybe look at an independent audit next year. But again, none of that has happened. We haven't had any instances like that. We haven't had any issues or potential issues, at least to my knowledge, that have come up. So it just, it's, I hate to take it back to you, but it's not a legal decision. It's really just a business decision in terms of, is it worth the extra money to get, to have the extra assurance, right? And so I think if it were me, that would be my approach, is how much more is it? Is it worth it really?
Okay, thank you.
Thank you. Yeah, it's $2,000
Yeah.
price difference.
It's a year, right?
Mm-hmm.
But this report could be given every 2 years?
We've been doing the standalone report every 2 years. Pretty much based on,
So
the board's been doing that.
2,000 every 2 years then.
Yeah, the standalone report is $2,000 more than the included report.
And we did the standalone last year.
Mm-hmm, correct.
So in theory, this is the off year.
To have it included with the city CAFR. I'm comfortable with just continuing the practice that we've been doing and stick with the CAFR this year.
It's your money.
It doesn't sound like a lot, per year, but when you run it out 5, 6 years or 7 years, it turns into a pretty nice chunk of money. But if that's, what you'd like to lean toward, it's just probably maybe for the best interest that we stick with what we got.
Yeah, I agree. So we would just need a nomination to move forward and approve the engagement letter for the non-standalone report for the $4,500 this year. I'll second. Any further discussion or questions? All in favor? Aye.
Aye.
Any opposed? So approved for the non-standalone to be included with the CAFR.
Can I ask one follow-up question? That's done by so do you guys stay consistent with those folks, with the CPA firms? Or is that like a state auditor that's doing that for you, or is it something that you deal with all the time?
Yeah, that's the city's auditor.
It's the city's.
Mm-hmm. Yeah, we could, he's already doing the work as part of the city's audit, so I think if we had a separate audit, it would be probably more, if we had a different auditor come in and do it, it'd probably be more expensive.
No, I didn't mean it that way. I just meant,
No.
who does it? Like, is it the cities or where it was coming from?
Yep.
I didn't know whether it was the state big brother coming down to watch little brother, or if it was an outside guy.
Outside guy. Next item is approving or presentation, the approved Division of Retirement Annual Report for fiscal year 9/30/19.
Okay, Madam Chair, included in the agenda is the annual report. We usually include this as when we get the approval from the state that the report has been accepted. So as you'll see in the agenda packet, we have the, first of all, the approval, which we got, on October 10th. So the process has changed a little bit the past few years now. It's all electronic, so, we kind of have to pull some strings to get what we have. So we've included the approval email, and then we've also included a copy of the report. So if you want to see, the final report that was transmitted to the state of Florida for the plan. And this information is in agreement, the financial information is in agreement with the financials that were issued.
Any questions or discussion on the annual report?
Do we need a motion to approve it? Or is this just a,
I think it's just a presentation that the state approved the filed report, yeah.
Just in time to do it again.
Yes. Next item would be excusing the absence from Carmine from the June meeting. We did notify ahead of time.
Yeah, the last meeting, he did attempt to call in, but we were having, various audio problems. Mm-hmm. So
Right.
I don't know how long he was able to stay. So.
I'll go ahead and make a motion to excuse the absence for Carmine from the June. Any discussion? All in favor? Aye.
Aye.
Any opposed? So approved. So next is attorney update.
Okay. Good afternoon, everyone. Thank you for allowing me to appear by phone. I appreciate it. Hopefully everybody's staying safe. This is a bit of a crazy time, and unfortunately, your jobs were hard enough before, so I can't even imagine what you're all going through now. But at least from my perspective, I certainly do appreciate your service, and we want to thank you all for everything that you do. Also, I would introduce you to my son, but he has moved on now to greener pastures somewhere outside. But at least there was only one, and he wasn't fighting with his sister, so it was a little bit. You guys got a better preview than you may have. As far as updating you guys, really a couple things I wanted to go over with you. First, the governor's executive order, which was recently extended, originally 20-62, most recently extended 20-193 through the end of this month. Again, it's still in play, which does suspend certain quorum requirements for public agencies specifically for a quorum of the board of trustees to be physically present in a physical location that's open and accessible to the public. So that is still suspended, allowing public agencies to continue to operate and take business and conduct its business through the end of the month. Now, the expectation is, although things seem to be getting a little bit better, the expectation is that we will again issue another executive order further extending, again, 20-62, but we'll certainly keep you posted and let you know if that happens or when that happens. For the time being, it is set to expire on the 30th, so, I know you guys are already meeting in person, so really nothing's going to change from your perspective, but it does allow for flexibility going forward, assuming he extends it. It does allow for flexibility going forward, to the point where if board members can't attend, whereas before they wouldn't be able to vote, now they can actually attend and vote. So not only participate in the discussion. So it does allow for some flexibility in case the board needs to utilize it. Also, I did want to remind you, with everything being up in the air, suspended, not suspended, extended, not extended, that your financial disclosure forms, those lovely Form 1s that we love filling out every year, they were due July 1st. So you certainly don't have to tell me if you didn't file it, but assuming everybody filed it on time, then I don't need to speak about it anymore. If you did not get a chance to file it, please just feel free to give me a call, offline after the meeting or at some point, and we can talk about how to get everything squared away. Okay. I did also want to provide, I believe, and I apologize if you didn't receive it, but I think you guys got a copy of a proposed amendment for the Secure Act. Did you guys get that? And the reason I'm saying that is I know we were rolling those out in the last month or two, but I'm just not certain that we got through everybody. So if you don't have it, then I'll stop. We'll be sure to send it to you when we can talk about it next meeting. If you do have it, I would just want to kind of describe what it is so that you understand a little bit better.
I don't think we've received it.
We don't have it.
Okay, that's no problem. It's something. It's an amendment that we would propose, and actually, since this is a League of Cities plan, I'm sure the League of Cities actually already addressing this. It's with respect to the Secure Act, and this is the Setting Every Community Up for Retirement Enhancement Act, which was signed by President Trump back in December of 2019. And so really what it does is it increases the required minimum distribution age. So if you guys have run into this, typically it's on the defined contribution side. So if you have a 401 or maybe you're 457, you are required to start taking your distributions. You can no longer defer taking your payments past the year in which you reach age 70 and a half. So now, in light of some growing demographic and socioeconomic changes that have been observed, specifically, folks are living longer, which we've seen as part of our mortality tables for our actuarial evaluation reports. Folks are living longer, better healthcare, better food, folks are taking better care of themselves. And on the flip side, folks are working later into their lives, and 9 times out of 10, they're not working later into their lives because they want to, but rather because they have to, because they haven't saved enough money for retirement. So the thought of the legislation was really to hopefully provide individuals with an additional 2 years or year and a half maybe to put some money away for retirement. So as a qualified plan, even though practically it's not going to have an impact, because again, especially in the public safety field, our folks are retiring much sooner than before age 70 and a half or now age 72. And similarly on the defined benefit side, retirees don't often defer receiving their pension payments because essentially they're forfeiting those payments. They're not getting those back. So, while practically speaking it won't have any impact, as a qualified plan, we do have to have specific language in the plan in order to maintain our tax qualification or tax exemption rather. So I'm sure that the League of Cities is addressing it, and so in hindsight, thinking about it now, maybe I'm sure the reason why we didn't send it to you was because the League of Cities usually takes care of any of those technical compliance amendments, and the amendment actually, based on the regulation, doesn't have to be adopted until I believe it's 2024. So that may be why it hasn't come across your desk yet, but at some point, I'm sure it'll be taken care of. But either way, we can follow up and just make sure that it's taken care of. But I'm fairly certain that it will be.
Pedro and to the board, Pedro, this is Jeremy. I can confirm our plan document has already updated that. So
okay,
that has been
there you
taken
go.
care of.
Thank you,
Yes.
Jeremy. Okay. And then really the only other item I wanted to maybe just talk about, and it's not an action item certainly, it's just educational opportunities. Obviously with everything going on, conferences have been canceled. So the FPPTA and the state school that are typically held now coming up, the FPPTA is first week of October in about 2 weeks, and the state school was shortly thereafter. Those have been canceled. While the state has not spoken or released any kind of plan to hold anything virtually, the FPPTA is going to hold its conference online or virtually. So if anybody is interested, that is something that's available. Obviously and convenient in the sense you can just kind of do it from home or from your desk, maybe if you have some time. So I would encourage anybody who is interested to go ahead and maybe register for that. Alternatively, I do know that the FPPTA is offering independent or kind of standalone education courses. I think they're maybe about $200 a session. And they're good. They're online. They're interactive. They're usually about an hour and a half. So if anybody has an interest and they want to go online and see what's offered, and one of those courses grabs your attention, and maybe you would sign up, and I would certainly encourage you to do so. But other than that, obviously we'll keep you posted and see how the spring turns out. So if we're in a better place, hopefully we are. And maybe there'll be some more opportunities available at that point. Really, that's it. That's all I had for my report. Unless there's any questions or anything that you guys might need from me.
No, thank you, Pedro. Anything we want to bring up before we adjourn? All right, just need a motion to adjourn.
I'll make a motion.
I second.
All in favor?
Aye.
Any opposed? Okay. Thank you.
Are you going to
thank you,
postpone
Pedro.
taking your pension?